This is Tom Fox. I'm the Compliance Evangelist, and I'd like to welcome you to the July edition of 1 Month to a Better Compliance program. This month, we're going to focus on 1 month to better internal controls. This month's sponsor is Workiva, and first, I'd like to have a word from our sponsor.
Thanks, Tom. Workiva delivers a modern internal control solution that connects risk and internal control information across the enterprise. The Wdesk Cloud Platform is collaborative, powerful, and intuitive, and optimizes documentation, testing, approval, and reporting processes. The platform is proven to increase productivity and drive better decision-making and is used by more than 2,800 organizations worldwide for financial reporting and ICFR processes. To learn more, visit www.workiva.com.
Over the next month, I'm going to explore several topics related to internal controls. We're going to take a look at what internal controls are and how they relate to a best practices compliance program. I'm going to help you understand how to design an internal controls regime for compliance, and then some of the specific internal controls for the functional disciplines within a corporate compliance program. We're going to take a look at the COSO 2013 framework around internal controls and explain how that integrates into your best practices compliance program. I think it'll be a fascinating month for you. We'll certainly explore the area of internal controls in depth. This podcast, 1 Month to a Better Compliance program, is a part of the Compliance Podcast Network. Day 21, Revenue Recognition, Internal Controls, and Compliance. In May 2014, the Financial Accounting Standards Board, FASB, issued Accounting Standards Update 2014-09 Revenue from Contracts with Customers, which I'll refer to as Topic 606, for public business entities, certain not-for-profit entities, and certain employee benefit plans. The amendments became effective for public entities for annual reporting beginning after December 15, 2017. In other words, we are now less than 6 months away from a new revenue recognition standard, which may significantly impact the compliance profession, compliance programs, and compliance practitioners going forward. Joe Howell, Executive Vice President at Workiva, spoke with me on some of the key changes and how they may impact compliance going forward. FASB recognized the revenue recognition requirements around the U.S. are generally accepted accounting principles, GAAP, differ from those from the International Financial Reporting Standards, IFRS, and that both sets of requirements needed improvements. This led to a project by FASB and the International Accounting Standards Board to jointly clarify the principles for recognizing revenue and to develop a common converged revenue standard for GAAP and IFRS, hence the new RevRec standard. The implementation will be a massive undertaking. The accounting standard itself is 700 pages long, and in the U.S. accounting literature, it replaced over 200 pieces of accounting guidance on revenue. The official name is Revenue from Contracts with Customers, and Hal noted there are a lot of surprises and things that are true for almost everybody is that they are going to be facing some level of change in the way they account and report revenue. They will certainly have to change the way they disclose things relating to revenue. There are included in the revenue standards over 6 pages worth of new disclosure requirements. One of the key differences in this RevRec standard is that it requires companies to disclose the information beyond data a company might have been required to release in the past. Hal thinks this will put pressure on auditors to get more comfortable with what the company provided to them, which they incorporate into their decision-making process in forming an opinion. For disclosure controls, this is something quite different because the auditor typically is not relying on those. This will create risks for auditors adjusting to the new RevRec standard because they will learn more about it as the new standard, apply it going forward into 2018. They may have to revisit it prior to reporting and revise some of it. The reason it is so important to the compliance profession and the compliance practitioner is internal controls over financial reporting involving implementing this new standard are critical to the effective use of implementation and indeed how you implement. The Securities and Exchange Commission has explicitly said in several public statements and through early comment letters on disclosures made in advance of implementation of the new RevRec standard that companies must inform the SEC about accounting policies that they are changing, how the new standard is going to affect a company's accounting process, and finally, how those effects are going to be managed. The SEC is making it perfectly clear that this is a real compliance issue. Moreover, the SEC has indicated that these disclosures are central to the new RevRec standard. Typically, if a company has some sort of failure in their disclosures for an accounting standard, they're treated under Sarbanes-Oxley 302 under SEC rules, and that has a level of significance or liability which is much lower than the liability a company might face under Sarbanes-Oxley Section 404, which has to do with the actual internal controls over financial reporting. While the disclosure of internal controls might typically not bring Section 404 scrutiny, under the new RevRec standard, they may now do so. Usually, when performing a financial audit, an auditor will not rely on a disclosure control from the past. However, under the new RevRec standard, if there's a change during the year in how an auditor views a disclosure control, it could require them to go back and figure out if the audit work that they did is tainted and whether they need to go back and do that work in the form of substantive testing, or they can go back and see if there were mitigating controls in place which allowed them to rely on internal controls to get comfortable with what the company provided them, for which they incorporated it into their decision-making process in forming an opinion. For disclosure controls, this is something quite different because auditors typically are not relying on those. Of course, this is overlaid on the requirements of effective internal controls under the Foreign Corrupt Practices Act and the lack of materiality standard. One only need consider the Wells Fargo fraudulent account scandal to see how the materiality standard does not prevent these types of risks from moving forward to become huge public relations disasters and hundreds of millions of dollars in fines and costs estimated at over $1 billion for the failure of internal controls. Yet there are other times to compliance which the compliance practitioner needs to understand and prepare for going forward. The prior RevRec standard was rules-based. As a lawyer, that was an approach I was quite comfortable with, both from a learning standpoint and a communicating to the business folks standpoint. But now the standard is much more judgment-based, and when the standard is more judgment-based, there can be more room for manipulation going forward. The response by compliance is to make sure that you have changes in the business processes necessary to gather the information that has not been previously required to continue to monitor. However, that information is factoring into judgments that managers must make as they report their revenue under the new standard, and those judgments themselves are properly documented. This final point demonstrates the convergence and overlap between the compliance profession, compliance programs, and compliance practitioners going forward. Compliance internal controls are in place to both detect and prevent. Now they can be used to gather the information which will be presented to auditors under this new RevRec standard. Many professionals are focused on the new RevRec standard from auditing and implementation perspectives. However, if you're a chief compliance officer, you may want to go down the hall and have a cup of coffee with your chief financial officer or find out what internal controls they might be changing or what they might be adding, and consider how that will impact the compliance in your organization going forward. So what are today's 3 key takeaways? Number 1, an effective system of internal controls provides reasonable assurance of achievement of the entity's objectives relating to operations, reporting, and compliance. But the key here is effective. As recently as this week, we had a FCPA enforcement action where internal controls were present, yet not effective. So the key issue is effectiveness. Number 2, there are 2 overarching requirements for effective internal controls. First is that they are present and functioning. Number 2, that there's an integrated approach. And number 3, with this new RevRec standard, you will have to monitor more closely from the compliance perspective. I know this sounds somewhat counterintuitive. Nevertheless, because there's more flexibility in the standard, there is more room for manipulation. And based once again upon the Halliburton FCPA enforcement action, which we'll take up in the next episode, I think that compliance officers are going to need to be able to work to have more effective internal controls. This is Tom Fox. I hope you've enjoyed day 21 to 1 month to more effective internal controls, and I hope you'll join me tomorrow, day 22, which will be our final episode in the July series of 1 month to more effective internal controls. This is Tom Fox. I'd like to thank you again for listening to this episode of 1 month to more effective internal controls. If you have any questions, please feel free to email me at tfox@tfoxlaw.com. If you have listened to this podcast on iTunes, I would greatly appreciate it if you would rate our podcast, as it would help in our rankings and also get the word out about the only monthly podcast series, which will enable you to have a more complete, efficient, and effective compliance program. Also, if you have any questions, please feel free to contact me at tfox@tfoxlaw.com. This is Tom Fox. Thank you very much for listening, and I hope you will join us again tomorrow.